So what's the big factor that you are considering? Is it pre-election spending, or what exactly do you think should drive the rise in inflation?
Thank you very much, Wale, for having me. I think the figure that we released last week shows that it will likely inch up a little bit again to 11.37 from 11.23 recorded in the month of August. So, and going forward, we observe that it's going to be making marginal increase. But what is important is the fact that we likely remain in the region of 11% towards the end of the year, till November, until it may peak out about 11.7 in December. The major driver is actually the rise in food prices that we see in the market. Remember, early in the year, in the first half of the year, we discussed that we may likely have single digit by 9.9% around this time, September. But then the slowdown, sluggish growth in agric sector, which impacted food production and led to rising food prices, really changed the dynamics. The number that was released in the month of August shows that the month-on-month inflation rate, food prices went up faster than the rate at which it went up in the month of July, and which is against the normal trend because of harvest season. But we've begun to see some level of disruption in the food supply because of the issues, the security challenges in some food producing states, and then even flooding lately.
I'm not sure you will agree, but I think if we're looking at how monetary policy reacts to this, there will be less concern around the rise in food inflation because the monetary tools really don't have a direct impact on this.
On that, yeah.
So what they will be perhaps more concerned about is the spending ahead of elections, and of course what we're seeing now with the higher monthly federal allocations because of the rise in oil prices. How do you see the monetary authorities reacting to this?
Okay, so the last time we were here also, we discussed about what the central bank may likely do in the last quarter. We released a note last week, which we call hike in U.S. interest rate, holding Nigeria, what next? And then what we think that may likely happen in Q4 is if there is elevated liquidity in the system that can bring about price stability, instability, then the central bank may likely, the MPC may likely respond. And the best way we think they may likely respond is possibly to increase the CRR a little bit. You remember that the last MPC meeting, what they said, about 3 people voted for an increase in CRR. However, and the central bank governor during the press briefing said they wanted to wait and see the impact of the liquidity in the system, because the minimum wage that we are talking about in the country, if it is approved, then money is the system beyond what they could manage with just using open market operations to manage. Of course, remember I mentioned that given the current structure, I don't even think that that minimum wage bill will be passed between an election, because for obvious reasons, it appears that we may not really have money, just because of the structure that we have at the moment. Yes, there are a lot of inefficiencies in the system that needs to be removed. Governments spend a lot of money that they need to cut down, which to enable them give workers living wage. But do we see that going on, taking place between now and election period? I sincerely doubt it. So if minimum wage does not materialize between now and election, if we don't have so much liquidity that will hit the system, if they're able to manage it within the issuance of open market operations, then raising CRR may not be necessary. But if we have election spending, it's in the system. If we have huge money coming from the inflow to pay minimum wage increase, then the CRR may want to respond. Raising rate CRR, MPR, may not immediately reduce the liquidity in the system if those 2 factors happen. And therefore what they want to do is to go via the CRR.
Although many will argue that that CRR increases will be insignificant because many of the banks are already paying, or rather, the effective cash reserve ratio of many banks is much higher than the 22.5%, which is the current rate. Okay, but let's talk a bit about that inflation rate that is linked to the rise in food prices. And how concerned are you about that dynamic? Is there a challenge with food production in Nigeria? Do you think that's at the core of the problem, or do you think this is a seasonal impact that we would see work its way through the system?
You know, looking at the government policies about supporting agriculture sector and then growing local substitution strategies that to ensure that we grow what we eat locally here. We had factored in those numbers in estimating our inflation rate early in the year. But then we have seen insecurity, the herdsmen killing farmers across the country, particularly the food producing states. That has impacted production, and that has reduced the amount of products that is available for harvest, and that is what we are seeing playing out. Unfortunately, like you said earlier, monetary policy cannot address this. It is government that can engage the relevant stakeholders to address that situation in the country. But I mean, today now we read it in the newspaper, the plans that they are making, even the document that Central Bank is, the federal government releases to do the investment show abroad, to say they are trying to privatize a number of silos to a private sector to ensure that they increase food production. If that does not take place, we may begin to see the problems that we are seeing at the moment, and it begin to impact inflation rate.
All right.